morning, everybody. It's Tuesday, February 6th. This is the AgYield War Room. Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments or would like to chime in on anything we're talking about, please drop us a note in the chat area and we'll get to it during the show. Quickly here, overnight markets had March corn up 1.50 at 4.44 1/4. March soybeans were up 6 at 12.02 1/4. March Chicago wheat was up 1 3/4 at 5.92. Want to point out here this morning, I know we've been averaging the last couple of sessions our February crop insurance price. Corn's currently sitting at 4.78 as of yesterday's close, and beans are at 11.78. Guys, looking at news overnight, nothing real earth-shattering here. It appears that weather is starting to take shape over in Argentina. They've needed water after this latest hot spell. Supposed to get water kind of today in through the rest of the week. And then there's much disagreement upon the 10 to 15 day, but that's kind of the case with all weather models. And then outside of that, strong export inspections yesterday for soybeans. It was nice to see them finally carve out a decent close and see a little follow through here this morning. So kick it around the room for some thoughts. Like I said, there's not much fresh, but it is nice to see a little bit of green on the board here this morning. Dust, what do you got for thoughts this morning?
Yeah, we are still in a downtrend, obviously. We have not been above the 20-day moving average since Thanksgiving for lead month beans, for March beans. And so that comes in right around 12.18. So that average has been coming down quite a bit. There's generally you're going to see dead cat bounces or just bear market rebounds during that process. The funds have been getting extremely short. They're not far away from record shorts between the soy complex and the corn complex. And so anything you see for strength, like yesterday's numbers, we saw the strength in the sales data. We've been uncompetitive with Brazil coming into their harvest. When we see anything positive, I think the market just sees that jolt. I do want to point out, it's interesting, like yesterday, wheat was down while beans were up. So any strength that we're seeing in beans is found as weakness in wheat, and flip. Any strength in the wheat seems to be a weakness in beans. So that inverse pair is still very active, and it looks to be active from the hedge funds. Managed money is the one that seems to be flipping on that still. And it's just that time of year too. You generally see markets supported this time of year. So if there's something that starts getting us up above that 20-day moving average or shakes those funds out, coming in from such a very large net short fund position in the complex and in the products, it could be a little bit more volatile than we normally would expect. So hopefully we see that. I mean, this is really a bad time for markets to be weak because we're setting lower guarantees. And we're not going to be as secure on margins for the average grower for what they can just insure themselves to for guaranteed revenue. 591 last year versus you say 478 so far as the average. That's a big difference in security when costs have not come down that much.
Yeah, that's a great point. And we're seeing more and more of it, Dustin, but the need to really analyze and look at, are there, special products or additional ways of purchasing up additional coverage of crop insurance to maybe set a better revenue floor heading into spring is probably really important right now. Would you agree?
Yeah, I actually really agree with that. And I'm glad you actually brought that up because, I've had some people say, well, where can I cut on costs? Maybe I'll go down on insurance. And I actually think that might be the opposite approach of what I would initially think is, there are policies out there that you can buy that are 95% policies that go off of your own individual APH. We call it like an extra 10% band coverage. But if you can get that extra 10% band coverage and also get the harvest option, I know those policies are rather expensive, but that could be, somewhat of a bridge on marketing, right? It would actually kind of downplay the dollars that have to go into Plan B type of marketing and just go towards more of a Plan B type of insurance. If you can get that shallow yield loss coverage for rises, because if we get a situation just like any of those situations in the bear market years of 2014, 2015, 2016, there were only, a good 2 weeks of really good selling opportunities that came during those June, July rallies, given whatever year it was. But those were the hardest weeks to sell because there was some sort of uncertainty given to the producer that made them not want to sell during that period of time. This is where those shallow yield loss coverage products, I think, really shine, is not the tangible expectation of a payment from those policies, but it's the certainty that you have of actually being able to sell into a rally, right? If you know that your payments start on the first 5% cut of yields on your APH, you can confidently sell into that, saying, okay, even if I don't have this bushel, I've got a rising insurance payment coming. And that's where the real benefit has been from crop insurance over the last 15 years of us trading crop insurance versus sales, is that it's the confidence to sell when nobody else wants to. That's the value of it. So I agree with that, Dan. Hopefully one good thing about low prices is volatility stays low, and maybe the cost of some of these things starts to come down a bit.
Sure.
So that's something we'll examine as we get into March 1st to see where things actually line up and whether or not it's a good deal to start buying up on some of these policies.
Absolutely. Any additional thoughts on the crop insurance piece? I mean, I think what we're actively doing right now is running through those hypotheticals, right? It's taken, if you've done any, preseason marketing or marketing up to this point for new crop and plugging that in against that crop insurance, just to be sure that you're, properly positioned, because the stakes are super high with these costs and what potentially is coming down the line here.
Yeah, I'll just add to it. Like, let's say, if we're looking at a matrix, on our matrix, price rises to the right. Okay. So when I'm looking at crop insurance at this time of year, I'm generally saying, okay, what do we have for, low yield, high price guarantee if we end up getting into some sort of a summer weather event? We really can't count on where the floor comes in at crop insurance, because we're only 3 days into the month. So the floor doesn't actually exist yet for crop insurance. So, we'll have a little bit of a clearer picture of what that means and what the value is to buy up, like, let's say an 80 or 85 or higher going into March 1st. But it's really kind of that end of Feb up until March 15th where like the rubber meets the road on value. Because if you're going way up past an 85% policy, now you're getting into the realm of marketing, right? If you're starting to buy 95% policy, that definitely starts to compete with some of the other things you might be doing with marketing, such as put spreads. And I know it's not perfect because it's a yield and price type of coverage, not just price only like the put spreads are, but there are some overlaps there of guaranteed revenue that you're falling into when you're starting to go up to the 95% policy. The way crop insurance works, though, is that you're averaging through the month of Feb, and then you're buying it by March 15th. And they're not changing that quote, depending on where the market goes. So if you see, like what we saw last year, a major price drop into the first few weeks of March, then all of a sudden the value grows because you're literally buying something at a price that is old. It's at a price that's fallen in value, but your quote hasn't risen like it would on the board. Conversely, it might not be very good if we set the price low through this month and then rally into March 15th. It might not be worth buying up this policy if you're trying to get into the realm of competing with marketing. So it is going to actually kind of be dependent on where we finish out the month, Dan, and go into March. So we'll have to have a lot more details and we'll have more focus on it in these meetings during that time as well.
Yeah, I think one thing just to add to that quick is, the kind of lazy marketing days aren't here, right? Where you can just buy up your cover, like buy up your profitability. It's going to have to be very active marketing, and this year, most likely. So, to your point, depending on how we end, month of February, kind of depends on how aggressive, once you buy your guaranteed bushels, even if they're low, it might just be having, to your point, just to be able to trade around those, right? So if you do have that, May, June, July rally, just having those guaranteed bushels, similar to what you're saying. But you have to actively, hedge around it, not just, start on March 1st with a high guarantee and then just put your head in the sand and forget about it. You probably have to be a pretty active manager either way after you get your crop insurance.
Well,
yes.
in this environment.
Kind of jumping onto both of your comments that I think are relevant too, that it's going to require an active marketing, and also to Dustin's point that there's low volatility, that because of that, maybe it makes those crop insurance products more economical, but at the same time, it's making structures less appealing. And we get feedback pushed back up to us and looking at things today that don't necessarily seem to be a great risk return on whether it's min maxes or different types of accumulators, because the volatility has come down so much. And a lot of times they're kind of sold as a carrot or a band-aid, and you're not fully sure of maybe what you're getting into is what we see a lot of times when we bring new people in. But it does tie those bushels up and those commitments up to keep you from being active. And I'm not against them if they fit or they're the right transaction for that person, but you have to be conscious that that those are locked up, and it takes away that flexibility of working around it.
Yeah, good point, Ben. And we saw that, really 2020 was the last time when usually it's during desperation, when people really start pushing accumulators or anything that's got a perceived premium to it. But to your point, you really have to look at what are you giving up for that, a lot of cases, small premium for a lot of, uncertainty that you're creating for yourself.
There's times when they make sense or on small bites. But I just to add on to that too, I think a lot of times in those situations, they work and they have ways to kind of bite you. But if you're working through a hedging account, you can pick something else to cover those additional commitments should it fail and go back down. So I think it's just opening your mind to the integration of how structures work with a hedging account, and not to be frozen if you go through your double up or you're worried about your downside knockout or whatever it may be. So I think that those things all tie in together. So.
Very good. We got a couple minutes left here. Ryland, I noticed yesterday that Tyson was up 2%. Their CEO put out a statement that he felt, and I'm paraphrasing, that basically expansion is slower than anticipated out forward. And I know that that's been a big discussion point of yours as we looked at, this report last week and kind of some guidance out forward. So what are your thoughts?
Yeah, well, he also said in the same conference call as regards to their earning that their beef business is definitely not as profitable, or at least pretty sluggish versus their pork and their chicken business. So something to note there, that retail meat prices are pretty high. But as far as expansion goes, like obviously the market's really set up to deal with this. It's going to be slow, but the cattle cycle in itself is a slow process. I mean, even if we started retaining heifers today and started calving, those aren't going to be market ready for 2 years. So a lot can happen in between there. Mm-hmm. There has to be market conditions that really facilitate that, whether that be weather conditions, pasture conditions, cheap feed environments. So we're coming out of all this stuff. And yeah, I mean, I think a lot of this really had to do with grain prices, DDG prices, and really the liquidation that we've seen. Definitely drought spurred in some areas, but on the other hand, we are seeing some pasture conditions really start to improve. So there's no such thing as fast expansion. I mean, these are cycles that last 10 years, and we've really been in the cycle of liquidation for only about 5 right now. So, I mean, I think the earliest we could see it is somewhere between 5 to 7. So we'll see. I mean, it's just one of these things that takes a lot of time. It takes a lot of effort. But typically when the market has to incentivize it, and we are starting to see that down the road. But as we know, it's most likely another year out, maybe 6 months at the absolute earliest.
Sure. No, it's good stuff, Rylan. Appreciate it.
Thanks.
Just came into the open here. We got March corn up a penny and a quarter at 4.44 and a quarter. March soybeans are up 2.5 at 11.98 and 3/4, and March Chicago wheat's up 4 at 5.94 and a quarter. Wanted to remind everybody that this afternoon at 2 p.m. Central Time, we are going to have an exclusive webinar with the AgYield team discussing ARC and PLC decisions and how those revolve around your marketing for this season. It should be a good conversation. Pre-registration is required, so if you have not yet registered, please let us know that you would like to. We can shoot you over the information. So we look forward to seeing everybody here this afternoon. As always, streaming live every day that the markets are open on X, Facebook Live, and YouTube Live, 8:15 Central Standard Time. Appreciate the visit here this morning, guys. It was good stuff, and look forward to talking to everybody here tomorrow morning. Have a great day.
Thanks, Dan.
Weekdays.